My name is Allan Madan. I'm a chartered accountant in the Mississauga and Toronto regions of Ontario, Canada. Today's short video is about the tax implications of becoming a non-resident of Canada. So if you're leaving Canada and currently are a resident, it's really important that you watch this video. Before we get into the tax implications of becoming a non-resident of Canada, let's talk about what causes you to become a non-resident of Canada in the first place. There are four main factors, and all of those factors have to be looked at as a whole, not individually. The first major factor is your permanent home. So if you sell your home in Canada and or acquire a new permanent home in your new country of residence, then you will become a non-resident of Canada. Number two, if your spouse and children leave with you from Canada to your new country of residence, you will become a non-resident of Canada. Number three, if you sell your personal possessions, such as your furniture, appliances, investments, and so forth, it's very likely that you are on your way to becoming a non-resident of Canada. Number four, if you break your social ties with Canada and establish new social ties in your new country of residence, it's more likely that you'll become a non-resident of Canada. Now that we know what causes you to become a non-resident of Canada, let's look at the 10 major tax implications of becoming a non-resident of Canada. What happens from a tax perspective? Number one, you must stop receiving the Canada Child Tax Benefit and Universal Child Care Benefit immediately upon becoming a non-resident. That means you should inform the CRA of your change in residency status. Number two, you are no longer entitled to receive GST and HST refund checks for credits that you were receiving. So again, you must inform the CRA of the change in your residency status. Number three, you have 60 days from the date that you become a non-resident, which is usually the date that you leave Canada, to repay any amounts that you owe under the Home Buyers Plan or the Lifelong Learning Plan. If you do not repay the amounts within the 60-day period, the balances owing under the Home Buyers Plan and Lifelong Learning Plan will be included in your income on your final tax return in Canada and subject to Canadian income tax. The fourth implication of becoming a non-resident is a good one. You get to keep your TSFA. So any money that's in there gets to stay there and you don't have to take it out. Number five, you should stop contributing to your RRSPs once you become a non-resident of Canada. You still can contribute once you become a non-resident, but it doesn't make sense to do so if you no longer have any Canadian source income. You won't be able to use the RRSP deductions because there's no Canadian source income to offset those deductions against. Number six, upon becoming a non-resident of Canada, you should call your bank and your financial advisor immediately. Your bank must begin withholding 25% tax on any interest and dividends that it pays you, as will your financial advisor. Finally, old age security, the Canada Pension Plan amounts will also be subject to the 25% withholding tax. You should also contact your pension plan administrator. So if you're part of a private company pension plan, call them because they must also start withholding 25% from any pension payments that you receive in your new country of residence. As you can see, the 25% is the overall withholding rate on passive income received when you are a non-resident of Canada. However, that withholding tax rate can be reduced by the tax treaty that Canada has with your new country of residence. Some of the rates are very, very low. Number seven, when you become a non-resident of Canada, you must list all of the property that you own if the property in total is greater than $25,000 in value. If you don't disclose this on your final tax return when you leave Canada, you will be subject to a penalty of up to $2,500. And I've seen clients being affected by those penalties for failure to disclose. So it does happen. Number 8, when you become a non-resident of Canada, you are deemed to dispose of all of your property at its fair market value, and any gains realized will be subject to income tax. And that's a really scary notion. Imagine selling all the property that you own today and having to pay tax on it because you left Canada. That's exactly what happens when you leave. However, there are some notable exceptions to the rule. Number 1, you are not deemed to dispose of real estate. Or number 2, pensions and RRSPs. Number 3, employee stock options. And number 4, life insurance policies. So for most Canadians, the deemed disposition rules upon leaving Canada will not be applicable. If you are one of those individuals that has extra money and owns investments outside of your RRSP in mutual funds or stocks and have big gains on them, be ready to pay capital gains tax on those investments. Likewise, if you're a business owner and own shares in a private company and your company is doing very well, be prepared to pay tax on the value of your shares. There is a special election available to defer departure tax, but that's beyond the scope of this video. The 9th major tax implication that you should be aware of when you become a resident of Canada deals with selling your home once you leave Canada. Once you leave Canada and you sell your home in Canada, you are liable to pay a 25% tax on the gross selling price to the Canada Revenue Agency. So if you sold your home for $400,000 after you left Canada, you would have to pay the Canada Revenue Agency $100,000 or 25%. That's a heck of a lot of money. There is a special election or forms that you can file with the Canada Revenue Agency to reduce the amount of tax to 25% of the gain on sale of your home. The gain on sale is computed as the selling price less the fair market value of the property when you left Canada. So if the fair market value of the property when you left Canada, your home, was $900,000 and you sold $390,000 and you sold it for $400,000, then the gain of $10,000 is subject to the 25% tax. That's much better, but you must remember to file the appropriate forms with the Canada Revenue Agency. The 10th and final major tax implication of becoming a non-resident of Canada is you must file a final Canadian tax return in the taxation year in which you leave Canada. So if you leave in 2011, you must file a return for the 2011 taxation year. On that personal tax return, you have to disclose your date of departure. Your personal tax credits will be reduced because they are prorated by the number of days that you were physically present in Canada. You have to list all of the assets that you own, like I previously discussed, if those assets have an aggregate cost of $25,000 or more. And finally, you have to file any applicable departure tax forms and departure tax deferral forms. I hope you found this video useful. I encourage you to visit my website at madanca.com, which is shown at the bottom of this video, for more great tax tips. So go ahead, visit my website and get some great tax tips that are going to save you a ton of money. Thanks for watching.